security interest. First, let me just lay out a gauntlet of UCCs that are all affected by your ability to understand what's at play. We're going to talk about UCC 9-203. UCC 9-203. UCC 9-203 is a security interest which is attached to collateral. And this is enforced when value has been given by the secured party, the debtor has rights in that collateral, the debtor has authenticated a security agreement that provides a description of the collateral. So, one of the major UCCs that are at play in most mortgage obligations is UCC 9-203. Now, when it comes to enforcement, it's about giving all parties the opportunity to make things whole, and their failure to perform implements an action which we will call enforcement. We'll tie this into a couple of other UCCs, which is dealing with the perfection of your security interest, which dovetails into UCC 9-308 and UCC 9-310. Again, that's UCC 9-308 and UCC 9-310, which deals with the perfection of the said security interest, the security interest that we discussed in UCC 9-203. Well, after the attachment, the secured party should perfect the security interest to protect its priority against other creditors. This is typically done through the filing of a UCC-1 financing statement. So, what most people don't realize, especially when it comes to foreclosures, and this is a prime example of how the DTC and DTCC work in tandem, is the creditor typically knows what he or she is doing, and most of the time the obligor or the debtor don't really know what's going on. They think they do, but they really don't. So one party has asymmetric information, the other is just going on what somebody told them. So all of these UCCs are in play when the creditor allows the debtor to observe, to look at, to comprehend, to participate, and the debtor unknowingly participates and doesn't raise questions, doesn't protect any rights. See, they'll even have documents that you're signing that's waiving your right to these protections. So when they do mortgages, they're supposed to have a UCC-1 financing statement on file to protect those security interests that they're going to turn around and go after you when you don't make a payment. What are the UCCs, Mr. Bay? UCC 9-203, UCC 9-308, and UCC 9-310. Now, when we step in through arbitration, and we know all of this has been put on the DTC side of the ledger, we bring forth remedy through arbitration and arbitrage, and then we enforce those perfections of security interest through UCC 9-308 and 310, because there are additional UCC-1 financing statement filings. Like, for example, if a mortgagor is foreclosing and you do a Title 11 UCC search and you don't see the initiating UCC-1 prior to the mortgage, prior to the payment going bad, but yet they want to foreclose, then it's just a matter of articulating who actually has been damaged and what type of remedy is available when you're in this Article 9 zone. which brings us to the enforcement of the security interest. The enforcements are carried out through UCC 9-601, and it goes all the way up to UCC 9-628. So you got UCC 9-601 all the way up to 9-628. So when it comes to enforcing your security interest, you're looking at those codes that range between 601 and 628. Now let's just discuss it from a default standpoint. Upon default by the debtor, the secured party has a right to do some of these things. Matter of fact, all of these things. We're only going to discuss a couple of these things in this realm. Matter of fact, we're going to discuss quite a few. First, when it comes to foreclosures, when somebody don't make a payment, somebody's trying to take possession of some sort of collateral. And sometimes they'll try to do it without, certain things. And this is what throws the debtor off. They're just taking my home. They're just this. And let me explain to you what they're doing. In accordance with the default mechanism, upon default by the debtor, meaning when you don't pay your mortgage, the secured party, which is the pretender lender, the mortgager, has a right to take possession of the collateral without judicial process, provided it's done without breach of peace. Breach of the peace. Breach of the peace. And, breach of the peace is heavily tethered to UCC 9-609. And a lot of individuals don't understand that aspect. Let me explain this to you. Now. Hopefully you guys have got your attention. Get some of the highlights from the weekend's podcast and broadcast, which was entitled Dealing with Funding Through the DTC and DTCC. That was part 2. Today, in loan officer training and compliance officer training, we will commence with dealing with funding through the DTC and DTCC, part 3. A lot of individuals do not understand how important it is to know your role. Some individuals get so wrapped up in that, well, I can be whatever I want to be and I can play all these roles. They forget that each role has a designating part. It has a tandem. How do I explain this? Is I use the mirror analogy, analogy, if you will. When you stare at a mirror, this is like the representation of the environment of commerce. So when you're staring at the mirror and you hold up your right hand, your reflection is holding up the left hand. It's working in tandem. So whatever you do in one direction, in tandem, there's going to be something being done equally in the opposite direction. And there's only one way the reflection and the individual entity are in unison. It's when that individual figures out that they don't no longer need to look at the reflection. They need to turn their back to reflection and lead it. When you're leading it, whatever arm or hand you're holding up is following. But in order for you to know where you're going, you got to know where you came from. So you got to first be able to stare in the mirror and understand how everything works in tandem. Then once you turn your back, you're able to lead the commercial transaction. So a lot of individuals don't understand this. So when they get stuck in the reflection, they're going left and something's happening on the right side. They're going right, something's happening left, and they're swinging left and right and hitting nothing but air. And it becomes frustrating, and they become complacent, and eventually just give up. The construct is designed to govern those that want to be governed, that need to be governed, the ones that are caught in the reflection. If you're strong enough, if you're learned enough, if you become responsible, fully responsible, then you can lead the reflection. So going from being a public notary to a civil law notary to a compliance officer is that evolution in learning. And there are roles that you have to play. And there are knowledge bases that you have to comprehend. It's not that you just need to be able to regurgitate and read it back to me. Does none of us no good if you can read it back to me. My question is, do you comprehend what you're reciting back to me? I mean, if you don't understand, if you don't have no type of comprehension of what you're reading, then you got to develop a comprehension. And these new AI tools, in my opinion, aren't to replace anybody's thinking. It's just supposed to enhance your ability to think. Give you, assign a role to your AI where it'll teach you. Like you can ask it to be the underwriter. You're trying to get a loan approved using UCC dot 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 dot, and see how that goes. Because you got to get into working this thing from the right perspective. Now, in dealing with funding through the DTC and DTCC, this is not the only way commerce operates, because remember, it's a tandem. I am simply choosing to explain it from a DTC equal to a deposit, DTCC equal to a withdrawal, to draw some conclusions, some fundamental conclusions. See, for those of you that have been with me for over 6 months, I'm trying to draw you into fundamental conclusions. Therefore, when you make certain things known, you're making these things not on speculation or not what Bazell Bay says, but through unequivocal fact that is bonded and insured. Like, for those of you that brought your paper and pencil to class today, I'm going to give you the history of commerce and accounting, and I'm gonna tag this into acronyms. So there's going to be acronyms that represent a framework of accounting that is in play right now. We're going to say that prior to Trump's administration, during the Barack administration, we were in FAST B95. And when the economic bubble burst in 2008, that was due to ALL, allowance, leases, and loans. Allowance for losses, leases, and loans. ALLL. So we had FAST B95. Then we went to ALLL. Then we went to CECL, which is CECL. And CECL implemented back in 2017. And from 2017 till 2023, banks and small reporting corporations who failed to become CECL compliant are now, as of July 2023, are governed under an acronym called DISE. DISE. So you are now unequivocally in the DISE accounting perspective. And that DISE stands for disaggregation of income statement expenses. Deaggregation of income statement expenses. Again, DISE stands for deaggregation of income statement expenses. Current expected credit loss provisions was CECL, and ALLL was allowances for losses, leases, and loans. So when you look at the series of acronyms that have governed commerce over the last 5 to 10 years, you are in an accounting space where failure to disclose, failure to report, failure to operate in the aspect of financial fiduciary responsibility is going to be fatal. This is why they introduced an artificial algorithm to look at those violators of FAST B95, ALLL, current expected credit loss provisions, and the deaggregation of income statement expenses. So if you fall into that long list of provisions, you are in trouble. See, the background of this income statement presentation deals with public companies, particularly those that deal in the manufacturing sector that lack specificity. The captions usually are generally established by the SEC. So this regulation came by way of the Securities and Exchange Commission. This is why there was an abrupt change to the Depository Trust Corporation and the Depository Trust Clearing Corporation in the aspect of their implementation. This is why there was a change in July. See, the scope of the proposed guidance was based upon the proposed updates applied to the public business entities filing and furnishing financing statements with the SEC. See, private companies, not-for-profit entities, and employee benefit plans are exempt. Did you hear that? Private companies, not-for-profit entities, and employee benefit plans are exempt. The update requires the deaggregation of expense captions containing specific natural expenses, including inventory and manufacturing expenses, employee compensation, depreciation, intangible asset amortization, and depletion and amortization for oil and gas production activities under the DD&A. So you're on the radar if you're dealing with inventory, manufacturing expenses, employee compensation, depreciation, intangible asset amortization, depletion and amortization from oil and gas production activities. And a lot of individuals, through their lack of saying, well, I'm a secure party creditor, it don't matter what you tell me, it's what you do. So in commerce, a lot of your activities got you on the radar. And because of that, these are the things that you're now facing. The proposed update outlines how disaggregate expenses for each required natural expense category. Certain expense captions, such as cost of products sold, cost of services, and selling, general administrative expenses, would need deaggregation, while others, like interest expense and income tax expense, may not. So if you don't have a proper balance sheet, and a balance sheet is a sheet that balances, if your sheet does not balance, you should have been using FAST B95. You should have been using allowances for losses, leases, and loans. You should have been using current expected credit loss provisions. And also with the new rendition, you should have been using deaggregation of income statement and expenses to make sure that balance sheet balances. Anybody's sheet that doesn't balance, you're in trouble. Are we clear? I'm going to now allow those that are clear. If you understand the words that are coming out of my mouth, then you don't need to say anything. If you don't understand none of what I just explained, I need you to speak now. If ever hold your peace, I need you to get on your keypad and press 9, 5, what is it, 9, 4? Yeah, press 9, 4 on your keypad. Press 9, 4 on your keypad if you do not understand what I'm explaining. And based upon my responses, that's going to determine which way I go. I'm going to give you a few seconds. Okay, because I got one person that don't understand. You know, I need everybody to be truthful and honest. If you don't understand none of what I just said, press 9, 4 on your keypad to let me know so I know which way to go with this. Because we're not going to circle back around saying, well, because I'm assuming you're understanding this. If you ain't used all of that and your balance sheet ain't balanced, you're in trouble. When I say you're in trouble, every individual that's considered a taxpayer or United States citizen owes the United States government over $300,000. This is how they're going to enforce it. Your balance sheet ain't balanced. That's how they're coming at you. Then I'm going to go and let you know this is how they're going to approach you. This is how they're going to breach your trust. This is how they're going to come at you with both arms swinging. And if you can't defend, if you don't know how to articulate, if you don't do proper reporting, if you don't do proper filing for those of you that are debtors, you're going to be in trouble. All right, so I got two people so far. It says, Mr. Bay, I didn't quite understand what you just said. Everybody else is saying they understand. All right. So for those of you that didn't understand, just hold what you got. What I'm saying in layman's terms, if I look at your accounting and between your income statement, balance sheet, and profit for loss, statements of accounts, whatever we decide to determine your value, and we don't see where these accounts reconcile and balance, you got four things that you're supposed to have used to balance this. That was financial accounting standard board provision 95. You was also supposed to use allowances for losses, leases, and loans. You was also supposed to be using current expected credit loss provisions. And as of July, they gave you one more bullet to put in the gun, which is deaggregation of income statement expenses. So at the end of the day, your books are all out of balance, and you didn't use one of those four or all of those four to make them back balanced. You're going to owe this $300,000 that they got tethered on this debt clock. That's what the business is. This is why they lowered the lending requirements, because businesses that's doing the proper reporting are going to be able to leverage. They're going to be able to do what we call an LBO, a leverage buyout. They're going to be able to do a leverage cash out. They're going to be able to do LBOs, which is on the DTC side, and LCOs, which is on the DTCC side. The DTC, we're going to say that's for making deposits into the court registry investment system. The DTCC is where it leaves the court registry investment system. So there's an accounting algorithm that goes with what I am articulating. Now, for the people that did not understand, what I'm going to attempt to do, because you got your hand raised, is I'm going to come to you and see, do you have any questions? Now, this is not for the folks that say they understand. Now you want to ask questions. See, there's a method to my madness. There's a method to my madness. Now, if you say you understand, just hold what you got. Let's see here. I just unmuted somebody. Let's see.
Yes, yes.
Miss Flemings, talk to me. Is it making more sense to you?
Oh, yeah. Two questions.
Okay.
When you say the ALL, right?
Mm-hmm. Correct.
And the FAST B95.
Yep.
When we enter those numbers into our ledger,
mm-hmm.
we're supposed to do footnotes, correct?
Right.
To enter that information in, the coding is correct.
Exactly.
All right. Second question.
Mm-hmm.
On our UCC, we upload information such as
your phone kind of got a little muddled for me. Say that one more time.
Should we upload the proof, say, we pulled from the GMEI? Should we upload that to our UCC statement?
Well, you can, or you can just simply, from that evidence, create a summary.
Okay.
Right. So you can, how you express your accounting is not etched in stone. There's just, long as you're able to articulate it where it makes sense and it's comprehensible.
All right. Perfect.
All right. Any other questions?
Nope, I'm good.
All right, so I'm going to go to Mr. Bay here. Let me see. I got Mr. Bay. He also had his hand raised, so I want to make sure that we are clear. All right, crystal clear. Mr. Bay, I think you're unmuted. Talk to me. Are you clear? Do you need some more clarity? Do you understand what we're talking about?
Can you hear me?
I hear you loud and clear.
Okay. Yeah, I'm trying to figure it out. Okay, so now all of these are still should be being used simultaneously today, but they all came about one at a time, right?
Right. Because see, it's an evolution. It started out as FAST B95. Then
Right.
they gave you another provision with ALLL. Then they gave you another provision with Cecil. Now they're giving you another provision with DICE, which is DISE.
Okay, so and we interact with each one of these through their forms.
You need to interact with these from their inception. Like based upon what you're doing in commerce, you should be able, your book should be able to balance. If you're giving me a statement and it doesn't reconcile and balance, you're in trouble. Because the algorithm is going to say that you're doing this to commit fraud. That's why it's no human being that's making this determination no more.
Okay,
If
so it's like
if the algorithm says 2 plus 2 is 4,
uh,
and you send me a balance sheet with 2 plus 4 is 400, you're in trouble.
okay. So now, so I'm trying to see like about like I don't get it when it's in like going back to you saying just use all of these starting at today, right? It's
Like
not
today, I want you to listen to me real carefully. Whatever you put on a UCC,
mm-hmm.
if it's a credit, there needs to be an equal and opposite debit. If it's a debit, there needs to be an equal and opposite credit. If you got a whole bunch of UCCs and you don't and you got them as credits and there ain't no corresponding documents for the appropriate debits to cover that, you're in trouble.
Gotcha.
You're in big trouble.
So the financing statement, it goes as it's reporting a credit. Well,
It can support a credit or a debit. It depends upon how it's used. Like you can't just put numbers on the doc and think, okay, I'm good to go. Because the algorithm is going to look for where's the reconciliation.
right, it got a balance. So if I
It got a balance.
right, okay, got you.
See, you don't get to play the real. Everybody wants to play the fancy. How can I create it out of thin air? You don't get to do that unless you're insured and reinsured. That's the advantage. When you got insurance, you can do all that. You ain't got no insurance. Your books must reconcile because they get to create value when they books don't reconcile. You don't get that advantage off the muscle.
Right. So now, when you say, okay, this is nothing I just need clarity on. When you say insured, right?
Mm-hmm.
And then reinsured. So
Right.
I'm saying on the front end when it's insurance.
It's got to be insured before you even. But before I even entertain looking at what you're talking about, I'm looking for not what you got on the paper because I don't know you. You could have made them numbers out of thin air. I want to see some insurance. I want to see a third party, an uninterested third party who is verifying what you're saying. That's insurance.
That's insurance. Got you. That's what I was trying to. Cause I'm thinking.
And then after you get the bag, we need to get it reinsured in case you fail to what? Perform.
Right. Okay. Okay, that's for the public safety.
That's if you are a taxpayer or a United States citizen in the federal zone, unfortunately, the AI that they got looking at you, that's what it's looking for. It's looking at everything you're doing, does it reconcile? If it ain't reconciled, they're after you. As a matter of fact, they ain't got to look for you. Your good dumb ass gonna call out to them because you ain't gonna know no better. I'm just saying it that way. They're not gonna beat down your door. You're gonna be sitting around waiting on money to deposit,
Right.
and you're gonna start calling.
Right.
That's what I'm saying. If you don't understand how this goes, I'm trying to let you know what's the default mechanism in this system. Creditors are not waiting on another shoe to drop. The only reason why commerce isn't happening is the creditors aren't contracting.
Okay. So basically, all of these four things that you mentioned here, they all just different methods of accounting.
Right.
Different ways for you to express what you're doing.
Right.
And they got to put in these parameters.
Right. The reason why they released this AI technology is you no longer have the excuse that I didn't know. Now, just because you don't read something, it don't mean that what was written don't exist. You just didn't read it. It ain't their fault.
Right.
They just got to give you an opportunity to figure it out. If you don't, you just don't. You're just in trouble. A lot of people are in commerce thinking their remedy is based on some sort of emotion. It has nothing to do with emotion. They tell you in the gangster movies is what? It ain't personal, it's business.
Right.
Why are you trying to make it personal? Before he killed a guy, he said, I really like you. You know, you're a good guy, you know. It ain't got nothing to do with whether I like you or not. This algorithm has been tethered to your numbers that when you don't do accounting, it is to punish you financially. Everybody that don't do accounting, you're going to get punished financially.
You ain't going to be able to get funding or nothing like that. So.
You're going to end up, see, people right now have property in estates that they have access to because they're financially literate. Those assets are a liability. It's a burden. This is why they say you'll own. This is why they say you'll own nothing and you'll love it. Because most people, long as somebody else don't do it, they don't care. They don't want to do it. Ain't it ironic that in 2008 they was giving loans to folks for $6,000 square foot homes that couldn't even afford the mortgages? They didn't take none of them people to jail. Listen to this now. Nobody went to jail now. Nobody. You look at the algorithm today, boy, they got Trump on a mugshot and this, that, and other. So people right now is like, man, they ain't playing. That's the message they want to send to you. And if you subject to the demarcation line, then yeah, this is not the time to play. For the last 3 years, I've just been trying to save the sable and get my people on the island of relevancy. I've been trying to get you to get your life raft and sail to the island of relevancy. And if you haven't set sail for the island, you're probably not going to be able to go right now, which means if you're still stuck in the chaos, it's going to get real stupid before it gets better. Like some of you guys that have not removed yourself from that tax block, you're going to be stuck in these 15-minute cities. It's all, as we get closer to October, things like what happened this weekend are going to become more and more prevalent, coming to a city near you. I got a lot of calls like that. You all right, Brother Bear? I was like, oh, I'm fine. You know, I'm good. You know, those things don't affect what we do here. But yeah.
You talking about the shooting and on Jacksonville?
Yeah. Yep. So you got to understand, people are feeling a certain type way, and they don't know what to do, so they going to what? Lash out. That don't help the situation. Now, I haven't gone into great detail. I'm just going to say, I ain't going to say an act of a coward. I'm just saying stuff like that, folks like that will end up trying to rob my mom and my grandma. You follow what I'm saying? They'll get mad and take it out on the innocent, women and children. So you got to be careful. Financial illiteracy right now can trigger a lot of things that they can justify. All they got to do, most folks only have $500 in the savings account. All they got to do is hold up your Cash App for about 3 days. That's all they got to do. You'll come to your knees. They know that. So, hopefully you're getting it. Any other questions before I move on?
No, that's good. I can keep my research on. I can go.
All right. Keep listening, everybody, because if you listen long enough, you definitely will learn something. You're talking about a breach of peace. If someone sends you a letter saying they're going to kick you out and put you and your family on the street, doesn't that interrupt? Doesn't that disrupt? Isn't that some sort of breach of the peace? Breach of the peace. It also gives them the right to dispose of the collateral and apply the proceeds to indebtedness. That's under 610. So the key to getting you to walk away and abandon your property is to emotionally tether you to that aspect. So when they do this without a judicial process and it interrupts your peace because you owe these people, you just roll over and play dead. Now, I'm going to get into UCC 9, 6, 10, but when I get into that and these other UCCs, I don't want nobody to get themselves in any type of trouble. This is why we're doing a 2-part series from yesterday after listening to what I was getting in terms of individuals trying to figure out how the funding of the DTC and DTCC works. I felt that I would be less than a fiduciary if I didn't at least clean up some of the mystery behind how it actually works. So keep listening, because if you listen long enough, you'll learn something.
Maybe, under the UCC, it states that you have to have 2 signatures from both parties to have a fully executed contract in addition to consideration. Let's not even talk about the consideration right now, but let's talk about 2 signatures from both parties. Now, can I go to say that I'm going to purchase your house without your signature? Most people say no. Okay, well, what if I put together a purchase agreement? I say I'm going to buy your house for $100,000. I go to the initial every place that I'm supposed to initial, sign the document, take that document to escrow, and say I'm going to buy your home. The escrow officer said, well, hold on. Do you have the signature from the seller? I said, well, no. I don't need the signature for the seller. This is a unilateral contract. If a unilateral contract is valid, that should be a valid agreement. I should be able to buy your house without your signature. It's impossible for me to buy your house without your signature. I know because I was in escrow. I can't buy your house without your signature. It requires the signature from the seller. Now, if that's true, and contracts are the same in all facets, in all areas, then this document is either truthful or it's not truthful. But it can't be both ways. Either this is a contract or this is not a contract. Okay, because I don't know about you, I don't have a signature from the bank. There was no banker present from one of the larger banks that I purchased my home, or who gave me, quote, the loan for my home. There was no one to sign that document. I was the only one present to sign the document. Matter of fact, no one notarized this document, which is kind of interesting as well. If this is truly a contract, wouldn't they need to know that it's really me who's signing this document? Well, this is interesting. This document, if you really break it down and look at it, it's very, very similar to something that I keep in my wallet called a check. Winston calls it a draft or bill of exchange. But think about it. What are the elements of your check? The elements of your check, you have a date. This document has a date. You have a routing number. This document has a routing number. You have who is paid to the order of. This document has who is paid to the order of. This document also has an amount on it. But the most important thing that this document has that actually executes this check is your signature. Now, let's think about this. If I were to give you a check for $1,000 And I signed the check, I put the amount, I put it who was paid to, put the date on it, ripped off the check, gave it to you, and you signed on that check, and you took it to my bank and attempted to cash that check, would you be successful? The answer is no. As a banker, we check the signature line, and if that signature line has two signatures and the other person isn't on that account, that we void that check automatically. So that check would not clear. This document, if it had the signature of the bank on it, it would not clear. You, I, all of us are the surety on this check. We're the ones who actually create the funds for this check with, yes, our signature. So once we sign, guess what? That's good as gold.
All right, which brings us to a very interesting point, because now what individuals are really starting to figure out is since our signature creates the money, then we're dealing with a level of funding or money that's tied into a security system of sorts, because, you know, it's a promissory note. He just made mention of a bill of exchange. My signature is creating the value. Okay, this is the DTC side of the equation. You're creating money when you interact with the DTC. So I want everybody to equivalent the DTC side of the security settlement system is where you would make the deposit. This is the deposit side of the ledger. Okay? So everybody understands that. Now I'm going to go to a question. I actually got two questions, and I'm going to go to one of my students who asked the question. Let me get into the space so I can look at the question here. It says, how can you purchase a house using trust without putting a down payment if you have a previous home or house that's in your name? Well, it's a couple of ways to do that. So let's talk about trust, and I don't want to, and again, the trust is a very, I want to say, loose way of saying what I'm about to say. There's over 90 different types of trust, and there's a very specific trust that you can use to do what I'm about to explain. But to give everybody kind of an idea of how you can purchase a house using a trust without putting a down payment if you have a previous house that's in your name, I'm going to give you a hypothetical. Okay, let's say the house that you previously have is in your name. We're going to call the name the straw man. Okay, we're going to say that you used your credit, and and when I say your credit, the straw man's credit, you worked a job, such as you are a teller at Bank of America. I'm saying like you bank at Bank of America, you work at the local grub and pub, and you bought a home and you're on a 30-year mortgage. Then you run into this trust information. And then you start hearing about all these different programs of how you can put the home inside of a trust, and you can actually, without doing a down payment and all this other stuff. So all this stuff sounds great, but you're kind of all over the place. So I'm going to take a person who was in a conventional 30-year mortgage, and before I give you the explanation, this is just one of the many different types of processes, but the fundamentals are few. The conventional person must be willing to accept a specific type of accounting principle. Rather, that's an accounting concept, which we'll call generally accepted accounting principles, an accounting concept such as the accrual method, the double book entry method, the equity or entity concept. These are all accounting concepts. These are all what's considered generally accepted accounting principles, and they are acceptable accounting concepts. Then we have what we call accounting conventions. And there are two different distinctive ways, but you must adopt a methodology, either a concept or a convention or a combination of both, but you got to have a preference because the preference is going to determine which way you can do this. So I'm going to say for laughs and giggles, you're going to choose the current expected credit loss provision. You're going to utilize a convention also, which is called the New York Convention. And when it comes to trust, you're going to operate under the Hague Convention number 30. I'm very specific. The New York Convention, the Hague Convention 30, and current expected credit loss provisions as generally accepted accounting principles. Very specific. So if you adopt that methodology, then one could actually take the conventional mortgage that they're in. They could identify that a conventional mortgage with a loan number and some sort of hypothecation scheme, such as you're paying a mortgage is tied to a pool of mortgages. We're going to call it a mortgage backed security of sort. Then that individual can actually create what we call a real estate investment trust. And the way the verbiage on that real estate investment trust is set up, they could technically take that real estate investment trust and create documents from the original loan, because the original loan is going to have documents that tie it into, okay, in our world, we were just talking about Uniform Commercial Code financing statement. And there's something in real estate that directly attaches to every UCC 1. In the mortgage industry, it's called a HUD 1. HUD 1, UCC 1. These two number ones always go together by someone who understands accounting and mortgage-backed securities. The civilian has no idea that they're supposed to be putting these two documents together. We're going to go back to, well, that's how the money is deposited to the DTC. See, when you take what you did at the mortgage table and that banker takes what you did at the mortgage table and put it together with that paperwork, they're making a deposit into the DTC. That's how the money is created. Now, this person, once they have identified all of this data and they do those filings, now when they get ready to acquire another property, they can simply use a CUSIP from that mortgage pool to secure the purchase of their next parcel of real estate, all being closed in trust without having to put down a down payment. Now, this is just one of the many different types of methods that fiduciaries are using to secure real estate without having to put a down payment down. Great question. Now let's go. And again, that was a great question that was asked. Just to further elaborate, real estate investment trusts operate through a proponent with REITs, and the verbiage on the REITs are compatible with the prospectuses that the investors are dealing with. So for those of you that are going to be participating in dividends reinvestment plans, that is like one of the variations of the drip. You know, of course, when you attach everything, when you make your mortgage payment, if you make $1,000 mortgage payment, you're getting back $3,000 to $4,000 per month. So that's how the property stays perpetual. Just for those of you that are trying to figure out how all that works. Love that question. Excellent question by one of the students that brought that to our attention over the weekend. And so it's about understanding that aspect. I want you to really understand that these UCCs that are in question are how this stuff works. But remember, we're now going into part 3 of dealing with the funding through the DTC and DTCC. So in part 3, let's look at some documents. So I'm going to go ahead and share some documents here. Let's go here. All right, we got this opened up. Let's see here. We're going to go to accounting. Those of you that can see my screen, you should see my screen and you should be able to see where I'm talking about the dual aspect concept, And this is out of your accounting manual. It's about 500 pages For those of you that are new students that do not have a copy of this manual, please make it upon request so I can make sure I can get you this manual for the new students that haven't already been in this space over the last 6 months or so. Dual aspect concept. This is going to open your mind. Check this out. It says financial accounting is transaction based. Of course, we only are concerned with transactions and events involving financial events or a financial element. In every type of business, there are numerous transactions, and if one takes a typical trading concern, the main activity is purchase of goods and their subsequent sale at a profit. This involves several transactions like purchase of goods from several suppliers, sales to several customers on cash and credit payment to suppliers, collection of from customers, payment of salaries to salesmen, purchase assistance, payment of rents and taxes, electricity bills, etc. In each of these transactions listed above, there are two aspects to be recorded from the point of view of the entity. For example, if there is a purchase of goods, it involves two aspects. One aspect is the receipt of goods. The other aspect is the immediate payment of cash in case of cash purchases, or the acknowledgement of debt to the supplier in case of a credit purchase. The recognition of the two aspects to every transaction is known as the dual aspect analysis. Modern financial accounting is based on such recognition of record of the two aspects of every transaction. The term double entry bookkeeping has come into vogue because of every transaction, two entities are made. For every transaction, there are two book entries that are made. One transaction, two entries. One transaction, two entries. One entry consists of debit to one or more accounts, and another entry consists of credit to one or more accounts. However, the total number of debited always equals the total amount credited. This balancing of debits and credits is the cornerstone of modern bookkeeping. How this accounting principle operates is illustrated with a few examples. Here's some of the examples here. Let's take a look at it. When Manish, the proprietor of the business, starts his business with cash of $40,000, the building is $50,000, then this fact is recorded at two places: asset and capital accounts. The capital of the business is equal to the assets of the business. This expression can be shown in the form of an equation as under: capital equals assets. That's going to be Manish in the building plus cash, and it's written like this: 90,000 equals 50,000 in the building and 40,000 cash. If the business increases the assets by borrowing 20,000, then the dual aspect of the transaction affects the equation as under: capital plus liabilities equal assets. So you got Manish and the loan, which are liabilities, equal the building plus cash. And if you write it in a numerical format, that's 90,000 plus 20,000 equals 50,000 plus 60,000. I want y'all to let this soak in now. I want you to look at this. And as you're looking at this, I want to see who's got any questions. Now remember, all you guys that said you got this, you should get this. This should make sense to you. Who's staring at this stuff and still are lost as two left shoes? Who's got any questions over what I'm showing you? Press 9-4 on your keypad if you got any questions. Press 9-4 on the keypad. I will do my best to bring you in. Now, if I've already brought you in and you were placed back on the in the queue, you should be able to unmute yourself. But if I haven't brought you in and you got a question, please press 9-4 on your keypad, and I'll definitely give you an opportunity. Any questions? Any questions? I don't see no new hands being raised. I don't see no new hands being raised. All right, I'm gonna take a stab at it. I don't see no new hands being raised, so I'm going.
Could I ask you
Sure.
to repeat the example you were going through?
Okay. All right. So let's go back to the example. All right. When I tell you can record the value in two different places at the same time, this is the example. So right here where you see where it says capital equals assets. So you got the person's name, who's under the capital, and then you also have the amount of capital, which is 90 grand. When you write it up, you write to the adjacent of it, you'll see capital equals assets. What are the assets? The building plus the cash. And what is that? The building is worth $50,000. He's got $40,000 in cash. $90,000 over here, $90,000 right here. Now, if the business increases the assets by borrowing $20,000, then the dual aspect of accounting works this way: capital plus liabilities equal assets. So what are the capital and the liabilities? Well, you got Manish, who is attached to the capital, plus the loan he took out. That's the liability. So the capital that Manish had was 90,000, and the loan was 20,000, which equals the assets, which is the building plus the cash, which is the 50,000 plus the 60,000. Does that make sense?
Yes, that made sense. Thank you.
All right. So that's how you use it in two different places at the same time. All right. Who has any questions? I'm going to take a stab at it. I think I see Trey got his hand raised. So let me just see. All right, Trey. I think you're unmuted. You got a question for me?
Yeah. So my first question was regarding the example that the gentleman was giving about like how he was looking at the notes to like that we have in our in our wallets. So he's saying that each has a like similar component. My question was the LEI. Can the LEI is our routing number instruments, or are we still just numbers off of the that we create?
Okay, hold on, because for some reason when you're asking questions, I don't know if it's my phone or what, it goes in and out. So let me just hold what you got. Let me. You kind of went in and out, so I heard like every other word. But let me see if I can fix. Let's see. I think it's echo, and that's what it is. We're getting some echo. Let me try to go here. All right, so let's see. Got the mic right there. Got this right here. All right, so now I'm gonna. All right, so now I'm going to go back into, that's the speaker. All right, ask your question again.
I'm gonna ask it in the short form. Can the LEI be used as our routing numbers?
Can it be used as your routing numbers? Okay. The LEI used as a routing number, you can, but that's a whole nother conversation. Like, you can pick whatever identifier you want to use. It's just there's ramifications for using it as such. Like, I stick with LEI and global LEIs because public is GLEIs, private is LEIs. That's how I interpret it. Now, it might be different in your book, but that's how I use it.
Right.
You know, you might be the opposite. You know, LEIs might be foreign and GLEIs might be, you know. The reason why, because the LEI already has a settlement system. It's real easy. It's like, unless I'm bartering, if I'm using quid pro quo, something of equal exchange, then I'll go into that CUSIV money market settle, if we're doing it on that level. But 99% of most commercial transactions, the individual who is doing the accounting, we get to set the tone on how we want value to move. The person who's lazy, they don't have a say so. So I love it when I'm in a transaction where somebody don't know what they're doing and they're lazy and they always want to say it's somebody else's responsibility. Now they got nowhere to go but where I want to take them. Like, okay, show me the last 90 days CTRs. If you can't show me that, then we don't need to bring up doing any type of debt derivatives that's going to cause a taxable liability. First off, you don't have any insurance, and I can't reinsure it. So I got to do all the stuff that you didn't want to do. I got to do the accounting before we transact. Once we transact, it's going to be based upon what has been bonded and insured and reinsured. And if you fall into the good graces, I'll be more than happy to hand you this M3 asset. Other than that, you're going to have to go through the court system and use your credits on your books. You don't get to hold. You don't get to convey. You don't get to make liquid. You're not even, unless you're licensed, bonded, and insured, I can't hand this stuff to you if I wanted to. Now, that's something that I don't determine. Your inability to be competent determines that. That's why the fail-safe is everybody who don't want to do accounting, well, good luck.
And
the elite.
And insure, what type of insurance? I didn't mean to cut you off.
Insurance is like, I don't want you to lock into, I got to have a special type of insurance because I've kind of went through the whole evolution of insurance to now I'm back at the starting point. So if you got life insurance, you got health insurance, you got mortgage insurance, you got car insurance, you got general liability insurance, whoever you are in commerce, are you bonded, licensed, and insured? If you are, then you need to be able to put that value on your book and be able to leverage it. If you can't leverage it, then the person who does know how to do these things, they get to use it because of your inability to use it. Remember, I just gave you the example of how you can use the asset in two different places at the same time. So just because I'm using it on my book doesn't mean you can't use it on your book. But I'm not, as a competent compliance officer, I cannot violate the Privacy Act of 74 by telling you what you should already know. I can ask you point blank questions. If you have a CTR, I'm going to ask you to produce those CTRs. Then after you show me those CTRs, I'm going to want to see your financing statements. Then in those financing statements, I won't want to see proof of insurance and proof of reinsurance. Now, with all those documentation, me nor you are worrying about the other party making what we're talking about liquid. But if we're not having these conversations, somebody's going to commingle. I just tell you up front, if I can't give it to you, I got to take it to the court. If I can't give it to you, I got to tell the IRS what's being done. If I can't give it to you, I'm going to have to get the Attorney General, the United States Attorney General, and all these other alphabet boys in the business because I'm not going down with the ship. And just because you don't know what you're doing, that ain't no excuse. If I produce my books and say these are the credits, you're supposed to say, okay, well, let me bring the appropriate debits to move this from point A to point B. That's the insurances and reinsurances.
So if we're supplying like the credits prior to any transactions or equivalent debits, then those are our equities, right?
They can be. Remember, you can adopt. It's about combining or adopting, principles that work for the integrity of the state. Technically, anything that you ask me, I can equivocally agree to because it's not that you can't. It's just rather for the time and energy of doing. That's the real question. You can commingle. Like if you want to, they got forms for commingling. Is what I'm. I don't know whether y'all have figured it out yet. There are forms for you to commingle. 1040, 1041, knock yourself out. And there are forms to not commingle. right now, because everything is with the DTCC, the SEC is in your business now. Because since the dollar has been debunked, they're gonna call the dollar what it is. See, they gotta control the narrative. It's a security. And if you're handling it, where's your license? Like, well, I didn't know I have to have a license. And then they're gonna take you to the first chapter of what had happened was. Like, when you open your bank account.
Right, but that's a whole other scenario.
Yeah, that's a whole. You got to remember, a lot of debtors are emotionally charged because that's their money. They quit to tell you what's theirs.
Yeah, but a lot of it too comes from misinformation. I mean, you got a whole
just because it's misinformation
that's out there that's
right.
Yeah.
But that doesn't. Commerce doesn't give you a pass because you was misinformed. You was ill-informed. Commerce doesn't let you, pass because you were lied to. It doesn't work that way. Before July, you could have gotten away with saying to me, I didn't know, Mr. Bay, so I should be able, that worked up until July. Now it's like, you got to tell that to the algorithm.
So as the information is being put into the algorithm, it's going to give us a response or it's going to say what it needs from us to basically keep the account, you know what I'm saying,
right.
in proper standing or in the right accounting.
Right. The IRS, every form that they have used and decided to use, take off the shelf, whatever, they publish a manual. Listen to this now. When is the publishing of the manual done? Before the form, like, all right, they publish the manuals
at the same time?
At the very beginning. So if you use the form and didn't read the instructions, who is liable?
All right. The individual user. And all they do is make revisions to the instructions.
Right. This is why they tell you now, the thing about it, because it's so much code and data, you can always amend a tax because you can discover new rules that apply to your previous situation. So they give you a magic eraser. If you mess up, no harm, no foul, amend it, change it. But here's where we get in trouble. We have been so used to being on the government's titty, I'm going to say it that way, that we believe that getting a tax refund is a good thing. And it's a felony. It's fraud. Like, you do know, like, if I ask you the questions if I was an auditor, and I see you hand me a 1040 form, I'm going to ask you for your identification. Then I'm going to ask you, are you employed by the United States government? And if you say no, I'll just work at McDonald's. So now this is what I got in my hand. I got evidence under penalty of perjury that you're a government employee. So either the form, you lied on the form, or you lying to me. Now, lying is not illegal, but I'm going to go back to, is this your signature? Because it said when you sign this, you're doing what? It's under the penalty of what? Perjury.
Right.
So you going to commit the felony, you going to commit the perjury from your own actions.
Yeah, but I mean, if it's based off of your signature, that's the surety, right?
If you sign that tax form,
you have insurance.
Listen to me carefully. If you just sign that tax form all willy-nilly like, you ain't got a leg to stand on if I know 2 or 3 things that I just discussed. You done did everything else. I just got to remember, I just got to hold the mirror up. I ain't even got to do nothing but hold the mirror up and say, okay, now make a left turn. Now, if you don't know that when I'm holding the mirror up, the only way you can make a left turn is to go right. Because you think you slick, you trying to make a left turn and you're going the wrong way. You know, this is how commerce works. All they do is hold up your actions. You can't make unbonded statements. So if you filled out this form wrong and didn't reserve your rights, the penalty of perjury is going to take you down through there. Common law just going to stand back and watch you be wheeled off to the insane asylum. That's all that's going to happen. Because what would compel an innocent man to testify against himself? It's math. Any other questions?
Yeah, but I'm a table monster right now.
Okay. All right. Let's go back to the forms. You now see where you can use value in two different places at the same time. The concept that we were discussing was called the dual aspect concept. Now, let's go to DICE, which is the deaggregation income statement expenses. And this is a data set, and this is for those that want it with their banking in the box. If you want it, I'll give you the price for it. You can pretty much have at it because it's got a lot of great things, quote unquote. Let's go down to qualitative description for non-required categories. To address expenses that do not fall within the required categories, the proposed update introduces qualitative descriptions. These descriptions provide additional clarity for investors about other amounts and relevant expenses captions. Addressing the inventory manufacturer expensing issues, the proposed update acknowledges the challenge of deaggregating expenses due to the inventory derecognition. To address this, a separate bucket of capturing costs in manufacturing process is introduced. Entities would further deaggregate this bucket into specific categories, including purchases of inventory, employee compensation, depreciation, tangible asset amortization, and DNA. Now, here's what I will do. I'm going to do this in real time since y'all watching my screen. Is I want some clarity.
We still see the accounting manual, though. It's not.
Y'all still see the accounting manual. Y'all don't see what I'm looking at, right?
Right. I don't see what you read.
Just bear with me. If you listen long enough, you'll learn something. Let's go here. Can you guys see my chat, GPT?
No.
Who can see it?
No, we can't see it. It's still showing us the accounting manual.
Okay, nobody can see it. Okay. Boo-doop. Let's see. Let's stop it. Since we ain't got nobody that can see it, let's put the entire screen up there so you can see it, because you were still seeing the accounting manual. Now you see my chat GPT now.
Yep.
All right. Now let's see if I can get a hit. All right, which is interesting. Let's look at this, shall we? It says tangible asset amortization is a bit of a misnomer. Let's clarify. Tangible assets, there are physical assets that have a finite monetary value and can be seen and touched. Examples include machinery, buildings, vehicles, equipment. The cost of tangible assets is not expensed immediately. Instead, the cost is allocated over their useful life through the process called depreciation. So when you got a tangible asset, you get depreciated. It's $1 million asset. You get to, over the last 5 years, depreciate it down to cost of $0. So you got to get the $1 million of use out of it. Sell $1 million worth of goods, it pay for itself. Intangible assets, these are non-physical assets that have monetary value. Examples including patents, copyrights, trademarks, and goodwill. The cost of intangible assets is allocated over the useful life through the process called amortization. So to be precise, depreciation is the method to allocate the cost of tangible assets over their useful life, and amortization is the method used to allocate the cost of intangible assets over their useful life. In the common parlance, however, some people might mistakenly use the term amortization for tangibles, but that's technically incorrect. The correct term for spreading the cost of tangible assets over their useful life is depreciation. Let me ask you a question. When you utilize depreciation under current expected credit loss provision, if you depreciate an asset, can't you recoup that lost value?
2 times.
Oh, don't get quiet on me now, especially for you guys that already gonna ask questions.
Twice on the current expected credit loss.
Can't you recoup depreciation under current expected credit loss provision?
On the current expected credit loss provision, you get it back a double credit.
Hello, is the mic on? Can y'all hear me? Hello?
You can't hear me?
Oh, I thought you could hear Dre. He answered 3 times. he said yes, you get a double credit. Can you hear us?
Can't hear.
Let's
Yeah,
see.
he can't.
Sounds like somebody's trying to say something, but for some reason, I don't hear him. Can't hear him. Okay. Why is that? Why can't I hear anyone? Can't you recoup depreciation?
Yep. Can you hear us now?
Okay. Somebody is saying something, but I'm not getting it back, so I'm going to have to play with this thing once again and get it. Let's stop the share. All right, share stopped. Go back over here. Yep. All right, everything is right here. For some reason, I'm still not hearing nothing. So let me go back over here. All right, let's see. There we go. I can hear you now. Say it again now.
You can hear
Can't
us?
you recoup? I can hear you now.
Right. You can recoup that back and get a double credit on the current expected credit loss.
There you go. So please be sure that you understand that when you do the accounting, there are rules that let you allow your books to be verified, authenticated, reconciled, and balanced. If you are staring at a ledger that isn't reconciling and does not balance, you got more work to do. It may come up, it may not, but to simply hand in your homework with some unanswered questions could be fatal. Answer all the questions. So with that being said, hope you guys are learning something. So keep listening, because if you listen long enough, you'll definitely learn. Go to another question that was posted. Okay. I have a question. It says, how can one prove there is a UCC jurisdiction if when a UCC 11 is completed and there isn't one on file? Do all commercial companies in the United States fall under UCC no matter what? To answer this question, in my opinion, you should ask the following. Is this corporation bonded? Is this corporation insured? And is this corporation or company possess a tax ID number, a DUNS number, some sort of state ID number where they're doing business in the territory? So they're going to have to cross the line federally and statewide, being both bonded and insured. If they are in that capacity, then they are required to do those UCCs where it shows up on a Child 11 search. Now, the reason why they don't do it is because they know most people they're dealing with aren't that savvy. So they're not going to make themselves liable. They're just going to hold you to something where you're going to be liable for your lack of performance. Hopefully that makes sense. Love these questions. Great questions. So, if you understand how these things go, you will really get the gist of how these things are to be implemented. Keep listening, because if you listen long enough, you definitely will learn something.
Let's go back to that first line. It says, in return for a loan that I have received. Now, generally, it requires, if I were to give you that $1,000 check, you don't have $1,000, correct? You don't have $1,000. You have $1,000 check. You have to go to the bank and cash that check or deposit into your account, and they have to withdraw from my account. Something has to take place for you to receive that $1,000. These individuals at the bank are so arrogant and so confident that this check is going to clear that they speak of it in the past tense. In return for a loan that I have received. They know that once you sit at the closing table, this check is going to clear. They don't have to worry about the check clearing. They just have to worry about your signature being on it. And once your signature is on it, they know if you're at the closing table, you're signing it. And guess what? They have $232,850. Now, let's talk about what happens to that $232,850 that's on this document. I'm going to put my title hat on for 1 second. What we do at the title company, and once again, please call your escrow officer and ask them what do they do with the notes when they receive them. I'm going to give you what we did with our notes and what most escrow officers that I've spoken to will do with their notes. We take the notes and we make 3 copies of the notes. Okay. We make 3 copies of the notes and we shred the original. Now, some title companies will actually send back the original with the 3 copies to the bank. Let's put the banker hat on. When I received those notes, they came across my desk, I would take them and stamp the back of them. And I actually have stamped notes that says for the pay to the order of without recourse to the name of the bank. That's kind of odd to put on a contract, isn't it? Well, a supposed contract. But that's what they would put on, that's what I would stamp right on the back of those notes. Doesn't that seem similar to that little check that I gave you for $1,000 that you took to my bank and they stamped the back of it? And have you ever taken the time to read what they're stamping? It says pay to the order of without recourse and then your name or the name of the bank. Basically, these notes are checks. They're called security instruments. Now, on Wall Street, instrument means money. It means cash. It's actually not cash. It means actually bill of exchange. It means promissory notes. It means things that can be deposited. It means things that can be exchanged for work. This document is actually a check. And that is the reason the bank cannot sign on this document. And that is the reason that this is not a contract.
When I stated earlier, a lot of folks don't understand how the DTC and DTCC impact their daily lives. They deal with it indirectly, but it's been around since credit cards, mortgages, insurances. Since you were given a checkbook, you were dealing with the DTC and DTCC. It's gotten it's become more sophisticated. So to elaborate on what Brother Rodney is talking about, the reason why they don't sign sign all that documentation, because you're creating the money, and you're not filing a UCC stating such. See, you're gonna actually create the money, and then when you sign all their paperwork, you're agreeing to paying back additional money that don't exist. It's pledged upon your future performance. Now, I can't give you proprietary information. Notice I said it. I can't give you proprietary information. I'm supposed to sell you proprietary information. So I'm not going to give you proprietary information. I'm going to say that if you've graduated from a public school system You are given just enough knowledge to put yourself in harm's way. If you have invested your resources and time into private education, especially in financial literacy, because in the public, they're not educating any professional on becoming financially literate. They have businesses that are built to pass along among their brethren and sisters asymmetric information, because everybody that's in the public is comfortable with someone else determining the welfare and well-being of their lives and their family life, especially their integrity. You know, Big Mama worked to have the house. She worked 2-3 jobs, did what she had to do. Now when you got the house, because you don't want to be responsible, take care of the taxes, chop down trees, build wings, this, that, and the other, you get the property and you sell it back to the bank. Big Mama fought to get it from the bank. Your dumb ass sell it back to the bank. Because assets are not supposed to be a burden, but they will be when you're used to not, doing certain stuff. So the entire system is rigged and catered to exploit these weaknesses. The DTC. Okay. Standard debt applications allow what you put on these applications to convert into a direct credit. Direct credit meaning it's being leveraged by automated underwriting software. Let me give you an example of such software, as I do from time to time, because don't believe what I'm saying. Just pay attention, listen, and if you look long enough, you'll learn something. Let me just show some of this software in action here. All right, you can see my screen. Now we're going to our automated software, which is right here under Apex Capital, under quote-unquote loan disc. And let's look at a couple of loans here just for laughs and giggles. And these are the ones that are already scheduled to be funded. So for some of you guys, you may see your name up in lights. Others, you may not see your name up in lights, but don't panic. Just understand that what I'm trying to do is I'm trying to show you something. See, we got about, $54 million is scheduled to be going out based on these 3 loans that are laid in this capacity. Let's see how many guarantors want to be involved with this particular loan. So we go to our list of guarantors. Okay, here's our list. We got Eternity Law, Go Capital. I think most of those loans are with Go Capital, but we got quite a few guarantors that are involved. And the guarantor are Go Capital and lenders in that capacity. Now, here's the deal. When you go to that website link that I sent you, and you have filled out all of your paperwork, and you've gotten to the part where you've done your KYC and your 1098F, and you have sent it back. When you send it back to this software, it's going to populate in this part of the system. I'm going to go here, and I'm going to go to my admin. And once I go inside my admin, let's see here. Is it doing something? Yeah. All right. Go to see where my forms are at, because if you've actually sent this stuff back the way it was sent, it'll show up right here where I'm showing you. Put that up there. Hit my submissions tab. My submissions tab is going to let me know everybody who has sent this stuff back in to me. It's going to give it to me, where they went, what they sent. I see Trey's been very busy, so he's been sending stuff back to me as we speak. Let's see. He's got a lot of stuff in this data line. That's Trey. That's Trey. Trey again. So I'm showing you this because when you send this information back to the system, it categorizes this information and it partitions it. And I'm just scrolling through. These are some of the others that have actually sent information back in. So the individuals and entities that have sent stuff back in, they've already been prepped to go out. But the monetization, here's where the magic takes place. You got guarantors like Go Capital that will particularly once they see a submission, they're ready to be attached to it. But you also got a proponent in here that deals with investors. These are your investors. And the investors actually have a back door into this platform. So you got Michael Strong that I'm talking to. Michael called me earlier. And also he got another partner by the name of Mr. Roberts who also reached out to me. And a matter of fact, Mr. Roberts insisted that I post a platform that we're doing with Apex Capital inside of our Bitrix space. And if you had a chance to look at it, we put the announcement out at about 2:54 today, which states, are you in need of short-term mortgage financing? Looking for bridge between the end of one loan and the beginning of another loan? We have a perfect solution for you. What we offer is an interim loan suitable for construction or rehab. It's a structured loan program that provides flexibility and the options to secure the most favorable permanent financing tailored to your business needs. Expertise in loans ranging from $100,000 to $100 million, catering to businesses with unique needs and situations. What are the rates? Our rates and terms are conventional lending bridge loans of 6.5 to 7% at one point. They also do asset-based lending for bridge loans of 8.99 to 12%, 2 to 4 points. We got swift closings within a week with a turnaround time about just 2 hours to 24 hours. You can get up to 100% LTV with additional collateral. Hint, hint, insurance. Equity participation in structured loans, interest-only payments. Loan terms can be 6 months to 30 to 3 years. And again, 3 years is a reason because it's a whole different structure. Why choose us? We cooperate with a vast network of top quality lenders nationwide, each specializing in diverse areas such as what? Securities, commercial real estate, accounts receivables, factoring, and various business equipment. We cater to all real estate scenarios requiring quick closings. With our 24-hour turnaround times, you can access the funds you need swiftly. Secure the cash you need by tomorrow with the right bridge loan from us. And they give you all the information. And guess where you will go register at that? Well, the same link you'll put in the stuff for your audit, because that's where our guys are looking for this stuff. So monetization hypothecation is about insurance and reinsurance. I hope I'm not going too fast. I hope this is making sense to you. If you got any questions, you need to speak now or forever hold your peace, because I am literally upon the completion of this class are going to be looking for those that are in the Bank in the Box platform to give me some sort of inquiry into whether or not they can use this structure in their platform. Press 9-4 on the keypad if you got any questions, comments, or concerns of anything I've shown you up until this point. Press 9-4 on the keypad if you got any questions and comments or concerns of anything you've heard pertaining to dealing with funding through the DTC and DTCC. Press 9-4 on your keypad. If you've already been unmuted, you can unmute yourself and ask your question.
So I have a quick question.
Mm-hmm.
So as far as the paperwork or the documents that need to be completed for depositing whatever the transaction is or whatever you're doing, that's sent directly to the IRS. That's not sent to your platform. That's sent directly to the IRS.
I send my portion to what's there to the IRS, because we provide the bond, and then you'll send your portion to reconcile the books. It's about balancing. So I will send you an attachment. Once you go through the audit, you'll get a completed case syllabus with tax forms, all the stuff you need to do what you came to do. Then it's just a matter of you tearing out your loose leaf and sending it to where it needs to go from that standpoint. We'll complete the accounting and cycling from our side of the book because we got to substantiate before you transact.
So that's concerning both sides, and that's for DTC and DTCC.
Right.
So whatever documents, whatever tax forms we're receiving, then it's our responsibility to send them out to the IRS.
To the appropriate parts. Yeah, do your reporting. Again, some of you guys are going to be on the tax block. Some of you guys are going to be outside tax block. I just are providing you what you need, so it doesn't matter where you at, you're covered.
Okay.
Any other questions?
Oh, yeah, I got one more quick question. So do we actually have I know we have an account number, but is there like we have our own arbitration number?
Yes. Matter of fact, on every one of these proponents, you got a unique identifier, and then you're gonna have, how can I say it? You got a designated number for what's being done, and when we do the audit, meaning that when your name comes up, we will go through transaction by transaction, provision by provision, so you'll know who, what, when, and where. And then you'll get a copy of everything, reports, the whole 9 yards. And then you just have to keep up the account. We maintain our side of the fence. You just got to maintain your line, if you will. Any other questions?
The reason why I was asking is because I was thinking about that the 1098F, and I'm thinking to myself, like, wouldn't I put a 1098F to the original arbitration that we did?
The original, basically, when you bring all these things into your accounting ledger, you're going to be able to justify it in the ledger, and then you just make reference to it. This is where the footnotes come in. Like you heard Monique was talking about being able to bring the ledger up to speed by putting the appropriate footnotes there. The key to reporting is detail and documentation. It don't have to be a whole lot of documentation, but you need to have enough detail that when we look at these financials, we can get to the meat and potatoes so the information is relevant. It's not about doing a transaction and then figuring out what to do afterwards. It's substantiating before you transact. Doing it that way, you can just hand another party a tax form for them to appreciate or depreciate their books. When you go back to this class, and again, don't listen to the class one time, oh, I got it, I'm ready to take off. No, you got to do this about 7 times for it to be relevant. I gave you a lot of information about depreciation and amortization. And it's knowing when to do one or the other, or both. Tangible, intangible. There's a method to it.
Understood.
Mm-hmm. All right. Any other questions, comments, or concerns? Press 9-4 on the keypad if you got it. I didn't even check the chat. Okay, we got. Let's see. Brother Clark, you was trying to ask questions. Let's see. Didn't know. Brother Clark, I just seen your message. You got a question for me, big bro?
Yeah. Can you hear me?
I can hear you loud and clear.
As far as like trying to assess the taxes or the stuff on like a court case, if they don't give me the dollar amount, how am I supposed to keep my books balanced?
All right. So indirectly, they did give you a dollar amount. So let me show you. When you get your court case and you pull your case deposition, that's a ledger. If it's a criminal case and you had to make bond, that's money right there. These are bondable offenses, and these create commercial liabilities in the public. This is why they'll tell you, if you're going to have a felony, it's going to be X amount of dollars to post bond, misdemeanor, X amount. There's money there. Now, if you trying to figure out, if you lack the information, that means you just sit around and wait until they finally give you information. On the contrary, there's a form for everything. So there's a statute in federal jurisdiction. Write this down. You're a notary, right? Before I say this, are you a notary? Are you a notary?
Yes.
Okay. All right. As a notary, there's a statute that you're going to use called statute. It's called a statute of necessity, and it justifies everything from a bad check to murder. And under the statute of necessity, there's a part of it that says that even when it comes down to murder, if you can demonstrate that a greater evil presented itself, the action is excusable. That's why it doesn't become criminal until you keep tongue wrestling with these people and you decide you're not going to do the accounting. All plaintiffs can only raise commercial issues. So if the state of Georgia, the state of Delaware, whoever the state of, if it says state of, they can only raise commercial issues. If it's child support, it's commercial. If it's domestic, it's commercial. If you was driving too fast, it's commercial. If you jumped on somebody at the club, it was commercial.
What about child custody cases?
It's commercial. Plaintiffs can only bring up commercial matters. It becomes criminal when you go into dishonor and default because you don't understand the question. You plead not guilty. All right. You don't plead not guilty. You're thinking not guilty means, you didn't do it. It means you did something else. And what you're doing is you're not paying.
Yeah. You ain't not to pay.
Right. So you're supposed to plead guilty to the facts and hold a pen up in your hand ready to endorse and pay. You can use the value in two different places at the same time. How do you think they're able to create money out of thin air? They get to use the value in two different places at the same time. Only those that can't do that are stuck waiting on something to happen and reacting. When the money comes out the ATM, it has the least amount of buying power. When it's on that ledger, it has the most buying power.
Wow.
Any other questions, big bro?
Nah, you answered it.
All right. Okay. Loving it. So again, keep listening because if you listen long enough, you definitely will learn something. And or debit on the DTC side of the security settlement system. All banks are taught how to take data off that application and register it. If it's registering, it's being registered in a court system. This is why it's called a court registry investment system. When you take your 1003 application, you don't think the 1003s are in the courthouse somewhere? Of course they are. Ain't this where they keep all of the real estate records in some sort of courthouse room? It's been registered. So when they put this information on these applications, your money creation, your ability to create money has been tethered and is equivalent to a deposit in this system. The court registry investment system takes that data and then it puts it into this general fund that they call a disputed ownership fund. That means everybody who did contracting thinking, well, I own my house, this, that, and other. You don't own your house, you're a tenant. But you think you do. But your value, that the money that you created, was just placed into a disputed, meaning disputed. It's up for debate. It's up for dispute, a disputed ownership fund. So that value from your mortgage, my car loan, your marriage, my marriage, all the stuff that we think we own, which we really don't because it's not about ownership, it's about control, all been placed on this ledger on the DT side under the court registry investment system. And it's given a name. It's called a fund, a disputed ownership fund. Now that it's in this fund, those practitioners that understand the security settlement system are able to make filings and applications to now enjoy that credit. So that's where that credit becomes a debit. It's a credit in the system. It's a debit out of the system. And all of these things are done through these various different Article 9 security interest that all of these institutions who know what accounting is versus you and I and everyone else who didn't know what accounting was. And a blind man's got no business at the table, and ignorance of the law is no excuse because the contract makes the law, and that they're going to ask you, isn't that your signature? So understand that you have been interacting with the security settlement system all of your life. And I've warned you that this past July, they made a major change because of what's happening with commerce around the world. And it is affecting everyone. This is why I keep preaching and stressing in all the previous classes that you're in the world's oldest, longest bank run in history. It amazes me that I don't have more people come in every week saying, Mr. Bay, I done took X amount of dollars out of my bank account. I want to be able to secure the integrity of my estate. What do I need to do? Because people are comfortable until their debit cards stop working. They're comfortable until something happens. You know, you enjoy the air conditioning in your car until it stops kicking out. You know, then when it starts, like, we need to get the air fixed. You know, we are reactionary. So if we, look, the only thing they got to do in America, even though the building is on fire and they done cut all of the wires so you don't hear the alarm, is the building you're in is on fire. And everybody who heard the silent alarm, they're all outside. The only reason why you're in is you're being entertained while the house is on fire. And that's exactly where you are right now. 2 years ago, you was complaining about, oh, my God, I got to wear a mask, and I can't do this, and I can't go outside, and this, that, and the other. And they kept saying, well, get a booster, and this, that, and the other. And then you find out you get all these things, and it still has nothing to do with why you even got the booster. Well, why in the hell I got the booster if it ain't going to protect me? It's about insurance. You're worth $11 million if they hook you to a ventilator and you get diagnosed with COVID. A lot of you guys don't even understand it because you took the vaccination. You voided some of your life insurance benefits. But that's another lesson. Keep listening because if you listen long enough, you definitely will learn something.
This is interesting. We're going to get to the promise to pay because I think this will kind of tie everything in. I promise to pay you $232,850. Okay. Let's use our check example of me giving you $1,000. So I gave you $1,000 and we put together an agreement. Okay, we're going to put together a contract. Okay, I'm going to give you $1,000. We put the terms, let's say 3 months. We put interest. So in that 3-month period, you're going to pay me back that $1,000. Okay.
All right, before we jump out of here, here's what I'm going to do. I'm going to give you the list unequivocally of all the UCCs that are imperative to the mortgage process for new compliance officers to know how to get on and get off. Now, this UCC list is not all of the UCCs, but these are going to be the UCCs that give you the most bang for the buck. And you're going to know exactly how to implement this from a mortgagee perspective. But those of you that are interested in the platform that Mr. Dion told me to post out in front of the Bitrix and the diversity limited space, please message me ASAP, especially if you're already a loan officer with Gold Capital and North Avenue Capital, because we can make some things happen, in lieu of. But let me give you the list of the UCCs. And with that, I'm going to share the screen. So we'll have it both recorded in both spaces. So everybody will kind of get the best bang for the buck. So here we go. Sharing the screen. Now, here's the screen being shared. All right. Screen being shared. Now the screen's being shared. Can everybody see my chat GPT screen?
No.
Okay. Are you in the shared link where you can see my screen?
Yes.
I'm sharing it. Okay. But you don't see my chat GPT screen?
No, I just see your family coat of arms.
don't see,
I can see it though.
okay. So if you're in the link where because I got a link where you can go in and you can see all the stuff that I share. Right now, I'm in the Chat GPT screen, finna go through the UCCs. If you don't see it, then just listen. I'm recording this, so once I put this back into the posting, you'll be able to see it as we go through it. All right, first UCCs. I'm gonna say them out loud, and then you're gonna see the list. You're gonna and when you're dealing with mortgage, you're always dealing with UCC 9-203. UCC 9-203. And what that does, that deals with the attachment of security interest. A security interest attaches to collateral when the value has been given by the secured party. The debtor has rights in the collateral. The debtor has authenticated a security agreement that provides a description of the collateral. So if those things are in play, you're under UCC 9-203. Next, you have UCC 9-308. Now, there's UCC 9-308 and UCC 9-310. So you got UCC 9-308, UCC 9-310. After attachment, the secured party should perfect the security interest to protect the priority against other creditors. This is typically done by filing a UCC 1. When you get into enforcement, meaning that you want to enforce your security interest. So this works both ways. This is what they're doing to you when they're foreclosing on the property. They're dealing with a UCC 9601 all the way up into a 628. If you're going to force someone into involuntary bankruptcy for them not giving you their bonding information, when they commit insurance fraud, and then you place a lien on them under violation of CFR 2711, then you can implement that utilizing these same UCCs. But again, let's break down what these UCCs are for. Upon default by debtor, the secured party has a right to take possession of the collateral without a judicial process, provided it is done without breach of peace. And when you're trying to do this under without breach of the peace, you're dwelling in UCC 9-609. So if I'm doing a UCC, I'm not breaching anybody's peace. This is why UCCs are so impactful. This is why you can nail them to the cross, where if you're trying to foreclose on my property and I did a Title 11 search and I didn't see one, everything that you're trying to do as far as eviction is a direct violation and breach of the peace. Because if you did it on a UCC, I can easily offer a K1 and give everybody what they want, because you're going to file that when you haven't been paid. If you don't file a UCC and you're still trying to get paid, that's deceptive. That's fraudulent. Next UCC you're going to be using is deposition of collateral. That's on the UCC 9-610. That's dealing with a secure party that can sell. So here's how you're able to dispose of the collateral. The secure party can sell. The secure party can lease. The secure party can otherwise dispose of the collateral after default. So once you haven't given me lawful legal money that's owed to the estate, I have a right to go capital and get a whole nother loan on that property and sell it to somebody else because you haven't paid me. The proceeds from the deposition are first used to satisfy the debt and any other reasonable expenses. Any surpluses must be returned to the debtor. And when you're talking about surpluses on a debt account or a trust account, you're dealing with UCC 9-615. Last but not least, in the aspect of conversation, I do not, in this particular class, can tell you what type of UCC that authenticates commercial liens. Hint, hint, wink, wink. When UCCs doesn't specifically use the term commercial lien, it does address the rights of secure parties to enforce their security interest in collateral if a debtor fails to satisfy an obligation. The secure party can enforce its security interest as provided under Article 9. So even though there's no specific UCC that perfects a commercial lien, if I'm smart enough to use an Article 9, then I can force the debtor into involuntary bankruptcy. If I enforce him into involuntary bankruptcy, any account number he has given me, any bank account he's given me, these are mine until the debt has been paid. So your remedy is always in front of you when you're using these in a certain type way. Please go back and listen to this recording because Mr. Bay is not telling you use UCC 9615 to implement a commercial lien. What I'm saying is if you just so happen to have a claim, you can force that person to involuntary bankruptcy using UCC 9615. The other UCCs I will not talk or express. I will just show my screen to protect the innocent. Hopefully you've learned something. Hopefully you've seen something that benefits you. For those of you that are interested in additional funding, please feel free to reach out to me through VIA Bitrix for any inquiries or what was posted inside of the space. And with that, I'm going to say peace and love, family. I appreciate your energy. As long as you keep doing what you're doing, we're not going anywhere. Peace and love, family. Peace and love.
Peace.